Greetings from FinStudy Club. My name is Ankur Kulshrestha, welcoming all viewers to a session on accounting for treasury stock, which is part of your 26th reading of financial reporting and analysis covered in CFA Level 1. Now, before talking about any point, let us clear a very important aspect that treasury stock has got nothing to do with the government of the US. The treasury bonds or the treasury bills that we are aware of are absolutely different than something known as a treasury stock. So please, for the lifetime, we have to just avoid this confusion and remember this point. Now, coming to the correct meaning of treasury stock, it basically means when company A, rather than purchasing stock of company B, tries to purchase his own stock. Now, a point to be recorded here is the promoter of company A is not buying the stocks of company A. It is actually company A as a legal entity who is absolutely empowered to contract is buying his own shares. It might look a little absurd. Well, not quite though, because you have done a very similar concept under the corporate finance, which is share repurchase, and in some countries it is also known as buyback. Now, buyback is absolutely opposite of issue. So let us just try and understand what is the impact when you issue a share. Let's say share worth rupees 120 has been issued. The face value was 100, so your cash collection is 120, out of which the contributed capital goes up by 100, the face value, and the balance 20 goes in the additional paid in capital, which has securities premium account. In short, your capital goes up by 120 and your assets go up by 120. In case of a buyback, just the opposite. If you have bought back shares worth rupees 80, your assets go down because the cash goes out of system and the capital, the contributed capital, goes down by 80. So, this is the buyback that you have done. Why I'm trying to explain buyback, because it is very closely related, although conceptually a little different than a share repurchase, because in case of buyback we actually cancel the shares, whereas in case of treasury stock we are still holding the shares. What happens is, let's say on 15th of January, company A made purchase of $120 of his own shares. A is equal to L plus C. Now cash goes down by $120 because obviously has been purchased from open market. The important aspect is investment into share of own company goes up by 120. So this is pretty much a treasury stock for you. Rather than investing into some other company called B, A has invested into his own stock and has been represented on the asset side. So I will come to the accounting aspect in a little while. Let's just understand the little bit of characteristics of the treasury stock. The first and foremost, it says, does not lead to reduction in share capital, unlike the share repurchase. So out of 1000, if let's say 100 shares have been bought back, if someone asks you what is the total capital pending, your answer will be 900. However, in case of treasury stock, your answer would still be 1000 numbers. Only for the representation purpose, I'm going to talk about it in the next slide. It is shown as contra equity. I will explain that practically, so it will be more convenient there. What is very imperative to note is that the treasury stockholder, which is the company itself, doesn't have a voting right, nor do they pay dividend to themselves. Now imagine there has been a lot of debate over this point, where a lot of students ask as to why can't you pay dividend to himself. Now the question is, dividend is paid out of earning attributable to equity shares, which contains PAT, which contains your non-operating income. Now the fact of the matter is, if I make payment of 20 rupees of dividend from here, Actually, this 20 is non-operating income for my own company. So effectively, your non-operating income goes up, PAT goes up, and EAESH goes up. So effectively, making any payment to yourself doesn't lead to any change. So then why bother? So therefore, and logically also, you can't be paying income to yourself. You can always pay to or receive from someone else. So you don't pay or receive dividends on the treasury stock. So in my example, if let's say $5 per share is the dividend, I am not going to pay that on 100 shares. I'm going to pay that only on balance 900 shares which are outstanding to the outsiders. Okay. Point number 5 is also very important, which says that although it is conceptually different, we have talked about the fundamental of substance over form, which says that in substance they are primarily similar to the buyback in case of EPS calculation or any other accounting parameter. So with that little bit of understanding about treasury stock, let's jump on to the accounting aspect, hardcore accounting, including 3 practice examples that we have got for you, wherein we are saying that your treasury stock is actually an investment, so should be shown on the asset side. However, it is shown as a contra equity. What I mean by that is, rather than increasing the asset side as investment in so and so shares, you are actually show that as deduction from the contributed capital. Again, from the point of view of the user, wherein we are trying to say that there are 1000 shares outstanding on the equity side and 100 shares of the same company being pending on the asset side. So the reader might get a little confused that these are also the shares of A Limited and these 100 are also the shares of A Limited. So rather than showing 1000 and 100, why don't you show 900 net on one side? So effectively it is like this. Okay, so looking at this practice example, let's just try and do this. First practice example, I know I haven't talked about the reissue as yet, we'll do so in a while. Let's just look at what happens on 15th of November. Google Incorporation purchased its shares worth rupees 45 from the open market. So again, A is equal to L plus C. Your cash goes out from the system worth 45, and the investments ideally should have been up. However, you don't show that on the asset side, rather show that as a contra equity. Okay. Now, another important aspect in case of equity or in case of treasury stock is the story doesn't end here. This is actually just halfway of the story. A treasury stock is bought for a particular purpose and under a lot of regulations. It's a very highly regulated area, insider tradings, etc. All the laws are applicable, so there is a lot of approval system involved herein. So let's say SEC has allowed us, let's say Google Corporation, to buy their own shares, and after 3 months, or let's say after 1 month, or whatever is the time frame, they will be reissued in the market. Now you would be aware that the market price is absolutely volatile, and the buyer from which you have purchased and the seller to which you're going to sell are going to be very, very different people. So they will transact at the then prevailing market rate. So on 15th of November, market rate was 45, while you will reissue on 29th of December, it will be something else, 47. So the point here is, on 29th of December, cash will go in the system worth 47. The deduction will stop, therefore the capital is going to go up. This needs to be understood in a while, that if there was something which was being reduced from capital, it is no more there, as a result of which the capital has gone up. The equation doesn't get tallied. That means you have purchased something at 47, issued it back at 40. You have purchased something at 45, issued it back at 47, making a gain of $2. This $2 can go to P&L, can go to OCI, or any other head. In any case, it will be part of capital, but within capital there are different heads. Let us now read this point. At the time of reissue, the difference between the purchase price 45 and the reissue price 47 goes to the securities premium account. That means neither P&L nor OCI. This is going to go to securities premium account. There is a very solid logic behind it. It says that the company obviously can do insider trading in a most effective manner. So perhaps a company which is not doing so well in its business but wants to up the ante by showing a good P&L might start taking shots on treasury stock. Therefore, the law has allowed you in a very regulated area, but still there are chances of insider trading. Therefore, there is another rule which says that come what may, your financial performance of P&L or income statement, should we call it, will not be impacted at all. If at all there is a gain or a loss, whatever you may call it, it will be transferred to securities premium account. Let's just do the second practice example. It will be interesting. A is equal to L plus C. Your share has been purchased worth 45, so your cash goes down worth 45, and so is the deduction in the capital. Now, since you have issued it at 42, cash will go in the system 42, the deduction will cease, and there is a loss of 3, which will again go down to the securities premium account. The third and a very interesting example is, the first part remains same, so I'm not going to do that your cash is going to go down the system and your contributed capital will be down by 45 in form of treasury stock shown as contra equity. What is critical is on 29th of December the company eventually cancelled. Now, had I was aware if that the cancellation will happen and this news was made available to me on 15th of November itself, I would have directly cancelled my contributed capital. Nevertheless, I will do that right now. On 29th of December, the share certificate which I was holding as investments will now be cancelled. No cash flow as such. Your treasury stock is no more. Therefore, you will remove the treasury stock from capital and you will reduce the contributed capital portion. Point to be noted, your statement of equity has got different areas. One is contributed capital, the other one is P&L, then is OCI, then is your securities premium account, then is your minority interest, and as a deduction is treasury stock. So the point I'm driving home is overall change in equity is 0, whereas one of the aspects, contributed capital, has gone down by 45 and the treasury stock deduction has ceased to exist. So therefore overall it has gone up by 45. So this also is an important aspect, that no change on the asset, no change overall on the equity on 29th of December, but within equity one of the heads have gone up, the other one has gone down. I hope the session was useful. We'll be extremely delighted to get your feedback or your queries at finstudyclub@gmail.com. There is a lot coming, different videos from different modules on different difficulty levels. So stay tuned. This was Ankur Kulshrestha. Thank you very much.